From the dot-com bubble to the financial crisis of 2007, the next financial crash is not a matter of if, it's a matter of when. If you're interested in knowing ways in which you can set yourself up for success regardless of the situations, then keep on watching. Everyone. So as I said in the intro to this video, the next financial crisis is really not a matter of if it's going to happen, but it's a matter of when. Financial ups and downs are just a part of the stock market. And if you've kept up to date with the story of the financial markets and the stock markets, you'll see that every few years really, and recently ever more often, there have been crashes in the markets, so-called also bear markets, in which the economy as a whole is in a recession. And if you're going to be invested in the market, you need to come to peace with this. You need to learn that these are inevitable and are part of being invested in the stock market. And there are actually ways in which you can even benefit for this. So put yourself in a strong position to not only weather these stock markets crashes, but also possibly profit from them. You can see to choose this as an opportunity for you to buy stocks at prices that are much lower than usual. So kind of like when there is a mass discount in your local supermarket where you decide to stock up, right, and buy things when they are cheaper. So you can choose to see financial recessions as something like that, but only if you follow these 5 simple steps, or principles rather, to ensure that you are in the best position possible to be able to thrive even in these hard conditions. So the first one that I want to talk about is you need to behave like a robot. Now, I don't mean generally, but I mean you need to start acting robotic and behaving robotic with the way that you invest. What I mean by that is you need to automate. As Warren Buffett said, you don't need to be smarter to make right financial moves. You just need to be more disciplined than the rest. So whether you do this through a robo-advisor or you can use any other platform, because these days they all pretty much enable and allow you to set up automatic transfers that happen automatically every so often. You need to make sure that this is something that will happen regardless of the broader economic outlook. So for example, what I've chosen to do is I use Trading 212. As you guys know, I've mentioned this multiple times. Every first of the month, I know that a set amount of money will go, no matter what, will automatically be taken from my checkings account and go into my brokerage account. And so it's money that as soon as I receive it, I already know that it's not mine. I just set it there, forget it, and I know that it's growing in the background. So what this does is especially important because when there is a market crash and when there are these recessions, it's very hard to remain rational. We are emotional beings, as human beings, and so it's very tempting, let's say, to see that when the whole stock market is going down, even like minus 20, 30, 40% at times, and even more really. So it's very tough to stay the course and remain invested in the market. But it's crucial because it's been proven that the time in the market is actually what matters. And actually, if you keep buying at the lowest, and if you're able to stick through it through automatic investments and are able to buy those stocks at cheaper prices, then when the market does eventually go up again, you will have made a lot of gains from this. So the technical term for this is dollar cost averaging, and this takes away some of the unpredictability basically of investing and makes sure that you are buying at different price points, right, of the index or the overall stock market. So not only the highs, also the lows, when the majority of people will be tempted to sell their shares and cash in, right? So behave better than the other ones, be more disciplined, and set up robotic investments. So set up automatic investments to go out every set amount of, you can do this weekly, you can do this monthly, however you prefer, but just make sure that it's, once you set it up, it's there and it will happen, and you don't have to make the decision when the time comes. The second point that I want to mention is a key one, and I've touched this in a previous video that I'll link below, but it's have an emergency fund set aside. Now, the whole point of having an emergency fund is that you don't have to dip into your retirement funds or your funds that you have invested if life throws you a curveball. Of course, it's super hard to predict when one of these, very tough market recessions or market crashes will happen. And so having this cushion, having this emergency fund set aside will help you sleep better at night. Also knowing that, if anything were to happen, you would have it and, it's there for you. And also the second thing is, for example, now in this latest recession, we've seen, of course, that the market has rebounded, but of course a lot of people, got laid off in 2020, unfortunately, and some people might even have had to go into debt if they didn't have any, emergency funds set aside. Now, before going into debt, of course, you would want to, if you have any money invested, you might be tempted to dip at those investments, right? And take a portion of your funds that you have in the stock market and cash them out to be able to survive off of them. But this is a very poor decision that is best to avoid at all costs, because if you take away the money, you are not only using that money, but you're also depriving yourselves of the future gains that the money would have made you if it had stayed invested in the stock market. So as much as possible, it's something that you want to avoid, and you want to just keep your money in the stock market for as long as possible. This is why having an emergency fund is key. You should only be selling your stocks because you want to, not because you need to. The third point that I'm going to be touching is setting aside a market opportunity fund. Now, what I mean by that is having a cash reserve of money, right, that you have lying around, and that it's specifically there for any especially good investment opportunities that you might come across. Now, this is by no means as important as an emergency fund is, so please do prioritize having an emergency fund set aside and then start investing, but you do want to go the extra mile. And if the goal is really to maximize the next market recession and the next market crash, then having a market opportunity fund might be a good idea. So it's just extra uninvested money that you have stashed aside and that you can use for when the stocks go on sale, aka when the market goes crashing down and everyone else is selling out and cashing out their investments. I know that a lot of people, not a lot, but I know some other people do this for other types of investments as well. So for example, for real estate. So it's good to have that in mind as a mentality. But basically the key principle here is, have aside some money, this, kind of market opportunity fund, that you can use to catch the market lows. And if you have this dry powder set aside, that's the best way for you to do that and to profit even more from the market crash. Now, the next point is creating multiple income streams. And this is so important and so key, because if there is anything that this last recession and economic crisis of 2020 has shown us, is that we cannot rely on just one way of making money. So we want to diversify our income streams as much as possible. And the gig economy has really made this quite easy, and platforms such as Fiverr make it super accessible to start doing this as well. So as for investments, you don't want to have all your eggs in one basket. And of course, this is something that you want to start working on quite early, so sooner rather than later, because it does take some time. It's not something that you will have ready to go overnight, but you might even be required to acquire some new skills and take some courses professionally, so do some professional development, and then set up a solid foundation for eventually starting to earn money on the side as well. So start working on this as soon as possible, and if possible, I would encourage you to focus on side gigs and side hustles that can be done online, because as we've seen, this gives you a lot of flexibility and a lot of opportunities to work on your side hustle whenever, really, without having to be reliant on being in such a location or external circumstances. So it kind of gives you that freedom of being your own boss, even though it's just your side hustle. And finally, my fifth point to help you thrive in the next market recession is to diversify your investments. So kind of related to what we said on the previous point and following the same principle, putting all your eggs in one basket is never a good idea. So ideally you want to be invested at least in 10 stocks. The more the better if we are talking about individual stocks. However, the easiest way, and I would encourage you to look into this first, and the easiest way to achieve this diversification without having to go out of the way and researching and identifying and picking individual stocks, is by buying into an ETF or index fund, such as the VUSA, the VUSA from Vanguard, so the S&P 500, or any other total market index fund. They hold hundreds, if not some of them thousands even, of different stocks sometimes. So it's practically as if you were owning a piece of the entire economy. Now, this not only gives you broad diversification because it gives you access to different companies, but it also exposes you to different industries. And as we've seen in the recession of 2020, it was, for example, the leisure and entertainment industries that suffered the most. But in the previous one, in the 2008 financial crisis, it was the financial institutions and retail that suffered the most. And in the dot-com bubble, it was the tech sector that suffered the most. So all industries can potentially be affected by a crash. And you never know if the next one is going to be your industry that is going to suffer. So the best way that you can hedge against this is by being exposed to many different industries, many different sectors, so that, if one goes down, the other one will go up and they will balance themselves out. You can also diversify by owning different asset classes. So not only having stocks, but including also a bit of bonds, real estate, and you can achieve this diversification also through indexes. So there are, for example, bond indexes, there are REITs, so real estate indexes that again allow you to achieve this diversification also across different asset classes. To summarize, the 5 ways to set yourself up for success in the wake of the next financial crisis is: 1. Invest like a robot. Be robotic and automate all of your investments. 2. Have an emergency fund set aside for any bad situation. 3. Have a market opportunity fund to really capitalize on the market going down collectively. 4. Create multiple income streams, or at least start working towards having multiple income streams, ideally online. And 5, diversify your investments. Now, nothing is going to beat true confidence and security when it comes to the investments that you make. You want to be sure in what you're doing financially. You want to be confident in knowing that you've taken all the necessary steps towards towards being in the best possible position for the next market crash comes. There is so much that we can't control out there, especially when it comes to the stock market. So you want to make sure that the few things that you can control, you are in control of, and you are in charge of, and you are aware of. Now, I hope this video was helpful for you, and I'll see you in the next one. Bye.